Hello everyone and welcome back. My name is Greg Furman and this is the Forex Weekly Outlook for the week of May the 30th, 2016. Now to get started this week we're going to again do things a little bit differently, so we remind everybody of what those direct intermarket correlations are when we're trading the Forex market, the commodities market, and of course the equity markets. Now, as we can see as of late, the US dollar index and the S&P 500 still sharing a very high intermarket correlation. We can see that as the S&P 500 sells off, the US dollar immediately reacts to that as the US dollar index recovers. Then for the most part, we can see the S&P 500 also starts to recover. Now, this correlation, again, there's a lot of things interfering with that. But the potential of whether the Fed is going to hike rates, whether they're not going to hike rates, a lot of things going on right now. But the one thing that is clear is that we are continuing to see the markets, again, highly correlated to the global equity markets. We can see it again with the DAX 30. It looks almost identical to the S&P 500 chart, and of course the Nikkei 220. Very, very critical index here. Now, again, we can assess that as that Nikkei sells off, the dollar index sells off with it. As the Nikkei 225 recovers, we can see that the dollar index recovers. So this is absolutely vital that we're looking at this when we're trading something like the dollar-yen currency pair, Euro-Japan, Great Britain-Japan, anything with the Japan currency in it. This is having an absolute effect, but also indirectly the US dollar. Again, very important that we understand what these intermarket correlations are. We can see the CAC 40, the France index, the exact same thing. As it starts to push higher, the dollar strengthens against the European currencies. These are the kind of things we want to make sure we have a full understanding of. Now, in most cases, oil runs in an inverse correlation to the dollar index, but we can see right now that actually as the dollar rises, so does oil. So the correlation that they tell us that oil goes up, the dollar goes down, that's not necessarily always true here, guys, and that's what I'm here to point out. So we can see again, as oil started to push higher right here, the dollar actually was fairly strong during this period until it then sold off right here, but then it immediately recovered on that rally back up to the upside on oil. So again, things that we have to be mindful of. Now the correlation can be, at times it can interfere with it because of things like interest rate hikes, oil inventory supplies, but predominantly the intermarket correlation comes back. What's very interesting here right now also is we can see the high correlation between gasoline contracts and the US dollar index. As that starts to rise, we can assess here as gasoline prices rise, so does the US dollar. Okay, as gasoline prices go lower, so does the US dollar. So not always 100% correlation, about a 75-80% correlation, but certainly something we should be paying attention to. And again, it showcases the power of the VantagePoint software to be able to show us these things. Now, as we look at our gold contracts, same thing here, guys. A very powerful inverse correlation that we all need to be aware of. At any time, if gold spikes, we can see the US dollar index immediately reacts to that. As gold moves lower, we can see the dollar regains its footing, much like what I said about in last week's Forex Weekly Outlook, that basically gold is still likely to remain under pressure this year because of the potential of rate hikes. So very little has changed there, but we are going to get more insight into that when we have the labor report this coming Friday, which is going to cause an excessive amount of volatility. There's no question about it. Now, as we come into our main currency pairs, just looking at the direct intermarket correlation between certain pairs and the dollar index, they're not always 100%. So we can see that basically the British pound, predominantly, if the British pound US dollar is going higher, then basically the dollar index is going lower. So at this particular time, we can see that the dollar index is rising, but so is the British pound. But that would tell me that one of these two is going to give way to some of that strength. So potential, which I'll talk about in a minute when we get into our direct pairs, but right now we can see basically potential weakness in the British pound. Now, With the Euro US, guys, if you're trading the Euro US, you are trading equities and you are trading the dollar index and you are trading oil. You just probably don't know that. So right now we can see that as long as the dollar index is rising and the S&P 500 is rising, the DAX is rising, the Nikkei is rising, then the euro is going lower. So the very second that turns around, the euro will rise again. That could be next week with the non-farm payroll, or it could be the week after next once we get that new payroll number. Same as the US Swiss franc. We can see 100% correlation here. As the dollar index goes up, indisputably, the US Swiss franc goes up. So basically that's telling me that the equity markets are likely going higher also, which is weakening the Swiss franc. That's what we're looking for. You can these correlations, intermarket correlations, guys, they are indisputable, okay? And they are there is virtually zero lag on these correlations. You can see basically it immediately reacts. This is the US Japan pair, excuse me, that how it's immediately reacting to this. So once again, if the equity markets are going higher, the dollar yen is going higher. That's how this works, okay? And they're absolutely indisputable intermarket correlations. US Swiss franc, excuse me, this is the one we were talking about a minute ago. Same thing as the dollar yen pair, 100% correlation. Again, when you look at these, most people only look at the currency pair. They put in certain indicators onto a chart. Single market analysis, guys, is clearly struggling over the last 5 to 10 years as these intermarket correlations take hold. So right now, if you're trading US Swiss franc, you are trading the dollar index. You just don't know it. So you can see that they react together. There is virtually no lag on an intermarket correlation. As soon as one moves, the other one follows that move. So again, these are all things that we have to be very mindful of when we're trading. Same thing with the US CAD. You can see here as the dollar index rises, then basically the US CAD rises. That means commodities could be going, like gold, are going lower. And again, when I talk about New Zealand US and Aussie US, they don't make up part of the dollar index, so they can move on their own. There can be they can be correlated inversely, or they can correlate together at times. It can go either way. And case in point, when we look at that, we can see it right here that as Aussie US goes lower, well, so did the dollar index. Now, as the dollar index started to rise, we can see that the Aussie didn't. So this can go back and forth, but there's another case there where they are positively correlated. So remember, Aussie US, New Zealand US, they do not make up any part of the dollar index, so we have to be a little bit careful. So from here, guys, now that we know our intermarket correlations, let's look closer at the pairs and the major index. Now, when we break it down by Forex pair, by certain commodities, by the US dollar index, we can see that we have a mixed signal here from VantagePoint, and this is the key thing that we definitely want to be looking at, that we have divergence forming right here. Our long-term predicted difference has moved into overbought territory on this trend line area right here. So when we notice this, our key vantage point level 94.93, that remains a critical level that we need to watch. We need to break free and clear of this, but my optimism remains guarded on further US dollar strength. We can see the medium-term predicted difference crossing over the long-term predicted difference from overbought territory. But our predicted RSI still favors further upside, and I believe the dollar will trade flat to slightly, it'll show some slight strength here going into the middle of the week until we get that ADP report on Wednesday and subsequently the non-farm payroll number on Friday. It'll be a determining factor. So right now we're up against some pretty stiff resistance here against this trend line. I believe we'll stay trapped between that trend line and the key vantage point level of 94.93 at least until Wednesday and we get that non-farm payroll number, the ADP report, excuse me. Now, if we look at the equities for next week, two things we have to take note here that I want to make sure I bring everybody's attention to. Now, I've demonstrated the high intermarket correlation the dollar has to the global equities, not just the S&P 500, okay? So we have a trend line break that's taken place right here on this, but we're coming up to a very significant swing high at the 2110 area. The key vantage point level is 2066. So in order for the S&P 500 to remain bullish to the upside, we have to hold above 2066. The indicators here again remain very mixed. If we look at this block of proprietary indicators from VantagePoint, we've got the short term crossing over the medium term and long term predicted difference, and we're losing momentum here. Now, our predicted RSI 76.3, you can see we're also moving towards overbought territory, but not yet. We've still got a little bit of room to move here, but we must clear this swing high at about the 2015-2012 area in order for the S&P to have any further upside from here, and my optimism on that remains heavily guarded, okay, and I mean heavily guarded. Same as the DAX 30, you can see we're coming up to a critical trend line resistance, our key vantage point level, 10,047.50. The euro will remain weak as long as the DAX 30 keeps moving higher, guys. Make sure you understand that intermarket correlation. The DAX 30, the European equity markets, and the euro, they do not go up and down together. One goes up, one goes down. Okay, so if the DAX starts to sell off, you want to get further shorts into the market. But if the DAX 30 sells off, then we want to get longs on Euro US right away. Excuse me, let me correct that. Okay, so the reason I'm saying that is that if the DAX 30 continues to push higher above through this trend line, then the Euro US pair is likely heading back towards the 109 area. Now, if we see crude oil levels start to push lower, then I've shown you guys the current intermarket correlation that gasoline contracts and oil are correlated to the dollar index. So if oil starts to fall, we could see the US dollar fall also. So keep an eye on that. The key vantage point level for next week on oil, we must stay above 47.50 for longs to have any chance on not only oil, but also on the US dollar index. Now, as we look at gold, one of the key indicators here from VantagePoint that I talked about last week that I basically said I'm not a gold buyer here, the VantagePoint triple EMA cross taking place on a break of this trend line that I've drawn in. Gold just getting hammered last week from the 1280 mark all the way down to the 1200 level, 1205 level down here. If we get a weak non-farm payroll number, gold is absolutely going back up, okay? But right now, we're not going to see that rise in gold probably until Tuesday, Wednesday, maybe even Thursday, once we get that ADP report. But the one thing I will point out, gold is moving into heavily oversold territory based on the proprietary VantagePoint predicted RSI at 16.2, suggesting we are going to start moving higher here. Very important that we look at these things because, as I've always said, and I talk about with my own direct clients on a regular basis, nothing goes straight up and nothing goes straight down. It just doesn't work that way, guys. When we look at the euro, you can see that the euro chart looks very similar to gold. As gold broke lower, it dragged the euro down with it. The bottom line, that intermarket correlation, and this is a great call from VantagePoint here again. You've got this triple EMA cross, just so everybody can see when exactly that euro started to sell off. We can see the triple EMA cross taking place at the 114 area, the euro finishing the week, closing out the week at about 111, a great move down. The key vantage point resistance level to start the week, 112.43. Shorts are favored while below that critical level. Now, the additional indicators from VantagePoint are predicted differences, an excellent way of gauging how a market is overbought or oversold. We are moving into oversold territory, but we do still have room to extend. I will point that out. So it really is dependent next week, the euro's direction on that non-farm payroll number, indisputably. And again, we're going to get a quick view of that with the ADP report. Now, the same thing here, U.S. Swiss franc, I've got a number of concerns with this, is that if the dollar starts to sell off, then of course U.S. Swiss franc will start to sell off. You can see this channel trend line that I've drawn in here. It comes right up here. The market has slipped below it. The only thing that's holding this pair up is the 8-day predicted EMA from VantagePoint, which comes in at, excuse me, I'm just going to get rid of that. Okay, let's go back up here. It comes in at 98.96, the 8-day predicted moving average from VantagePoint. The further support level we have, the 18-day predicted EMA at 98.30. So that your support zones are right here between these two, basically 98.96 and 98.30. As long as 98.30 holds, then there's still an upside bias for the dollar. That's the case in point that I'll make for it, for at least for the time being, to be clear. So again, our indicators from VantagePoint, they look very much like the dollar index that I showed, where we have the long-term predicted difference moving into overbought territory, and the divergence of the fact that it's moving lower while the market moves higher suggests that there's very little upside left on this particular pair. Now, as we go into the British pound US dollar, again, this is a very interesting pair, because when we look at the exact failure price this week is not only right on the trend line that I drew in from last week's Forex weekly outlook that continues to hold, but I outlined that the area around 147.30 is the yearly opening price. So basically, if you bought Great Britain US on January 1, 2016, you're basically down about 140 pips, right? So if you sold it on that January 1st, 2006, you're up about 140 pips. But in order for the British pound to truly be bullish, we must be above that yearly opening price. So right now we are trapped between the 147.30 area and the key VantagePoint 18-day EMA at 145.33. So 145.33, we'll look for this area right here to hold. If we lose it, we will probably come down to 144 before we see the buyers start moving back in. Now, with the dollar yen, the dollar yen is going to be the toughest pair to trade on the week of the non-farm payroll number. Strongly advised to, minimize your trading around this pair on the week of a non-farm payroll number, because it's very, very choppy. We have a very strong trend line resistance coming in at about 111.40, 111.50, and we have the key vantage point level at 109.42. Now, what I will point out, so everybody can see, we have 1, 2, 3, 4 hits on the key vantage point level at 109.42. Now, to start the week, this level was sitting at about 109.10, which I talked about in last week's Forex weekly outlook. The market immediately came down to this level on Monday of this past trading week and then bounced out of there. But then it's banging up against this trend line that I've drawn in. So again, we've got a very tricky play here on this one, but we need to break free. In my respectful opinion, we need to break free and clear of not only 111, but also of this swing high of 112 to really see this turn bullish. I'll point out that the yearly opening price in the dollar yen sits at about 120. We're about 1,000 pips below that, so not exactly bullish on the year. And what's very interesting about the dollar yen pair is that essentially, with the high correlation it has to the equity markets, the equities had a pretty big move up last week of some 40 points, and the dollar yen did nothing. So that basically warns me that the move in the equity markets is probably exhausted and it's getting ready to turn lower, which could in fact turn the dollar yen significantly lower. Now, our indicators here are very mixed around the zero line. Predicted RSI says we're going higher, so it'll be interesting to see how this one plays out, but we must break free and clear of this 110.50, 111 area, get up above it if we have any chance to actually move higher next week, which I actually don't think is going to happen, at least until we get that ADP report on Wednesday. Now, as we come into our main commodity currencies here, you can see that the US CAD is running right along this trend line here, but then the trend line broke. You can see that the VantagePoint Neural Index immediately picked up on that. And the Neural Index rate here, you can see that as the market started to move, basically lose momentum with absolutely zero lag, the Neural Index said, look, we're going lower right here on the very next trading day. So the strength indicator, the predicted differences, couple of things here going on here, guys. The key vantage points support level 129.68. We've closed at 130.20. So the market is still technically bullish while above the 18-day predicted EMA from VantagePoint 129.68. But you can see that we've got a crack in the dam here. So the predicted RSI is below 60, but it's holding it's holding at the 56.4. So as long as it's above 50, it's still technically has a bullish bias. Below 50, a bearish bias. Above 60, quite bullish. Below 40, quite bearish. So right now we are holding on that VantagePoint support line of 129.68. You can see that we came on Friday down to that exact number of 129.67, and then we shot out of there by 100 pips up to the high at 120.67. Nice trade for the person using the software and knows how to basically identify these key levels. So for next week, right now, again, 129.68 is the key level. We need to hold above that if we're going to go lower, if we're going to go higher, excuse me. And that will be determined largely by oil contracts. Oil keeps going higher, then US CAD will keep going lower. But if oil turns lower, then basically the US CAD pair is going to go higher. Now, with Aussie US and New Zealand US, it just doesn't seem like anything can save the Aussie currency. We've got the RBA minutes came out last week. They're negatively impacted the Aussie currency. But largely we can see that essentially we've been moving lower here on the indisputably moving lower since going back to the original triple EMA cross at the end of April. We can see right here VantagePoint started calling this essentially a month ago. So the people that are getting aggressively short here, I would be very, very careful with that. We've already been in this short trade for a month, guys. So chances are it's probably getting ready to turn back up soon. So we have pretty strong trend line support coming in just above 71, so we'll keep an eye on this area here on this lower trend line, and we will likely head back to the key VantagePoint level at 72.90. Okay, so it is still an equity-based trade though. That's what I will point out. So keep an eye on those equity markets. We do really need them to keep moving higher to kind of assist this trade, but again, most of these indicators from VantagePoint, you can see that they're telling us here, based around the long-term predicted difference, the medium-term predicted difference, even the short-term predicted difference in the strength indicator are warning us that this trade is losing downward momentum. This short trade that people are just getting excited about getting short on Aussie US over the last few trading sessions, when in actual fact we've been short for over a month, and they're doing what most traders do. They're coming at the end of a trend hoping to catch a few pips. Be careful you don't get caught in a bear trap down here, guys, because that is what at this present time it does potentially look like this is a bear trap forming. So be very, very cautious. Same as New Zealand US, you can see that our trend line is running right along the VantagePoint 8-day predicted EMA at 67.39. Now, I've talked about this one again for several weeks, guys. We've been holding above this trend line, and even this week here we've just managed to close below the lower trend line. But again, we've got to be careful here. The key VantagePoint level 67.74, that's the area to watch here, guys. If we start to recover off of this lower trend line on Monday, Tuesday, Wednesday of next week, we are likely going back to 67.74. If we can get back up above that, then that will bring these swing highs back into play, back up around this 68, 69 area, back in this zone up here. But again, I think that, my optimism on that right now also remains somewhat guarded, because as you can see, the key VantagePoint indicators here, the predicted short, medium, and long-term differences, our neural index, our predicted RSI are telling us that potentially we have more downside. So if that's the case, then, and we can hold below those levels, we would likely come down into the 66 level, but be careful of a bear trap on this one also going into next week. Now, in my respectful opinion, I don't think we are going to get a rate hike in June. I think they're talking it up here. I think the Fed has left the door open for more speculation. There's going to be a rate hike. I can't say one way or the other. It's basically, it's a crapshoot. So, as the market starts to digest more data, the non-farm payroll number coming this week is very, very important to us as to if the labor market is showing some very strong numbers, then we could see a rate hike in June from the Fed. There's no question about it. And if that's the case, the dollar will make further gains right across the board, sending the Aussie lower, the New Zealand lower. the CAD, and it will overtake, even potentially even overtake the Japanese yen. So a busy week next week, but I'm sure it'll be a great trading week for all of us.